Private equity funds are usually established as private partnerships. As such, the private equity firm is the general partner and the investors are the limited partners. The amount of funds that the limited partners agree to provide the private equity fund is called the committed capital, which the fund gradually invests in multiple investments over a period of 3 to 5 years. Investing in private equity involves higher risks than investing in stocks. Thus, investors require a higher return to compensate for the risks, such as the risks associated with illiquidity and leverage. As with hedge fund reporting, the performance reporting by private equity is subject to survivorship and backfill biases, both of which overstate returns and make the private equity indexes unreliable. Prior to 2009, private equity firms did not mark their investments to market, thereby causing their volatility and correlation with traditional investments to be understated. Find the full private capital characteristics and performance evaluation video on www.cognivisio.com.